Hi there, Serial Trader here. Let's check in with the major US indices heading into next week here. And it's been a choppy week since the last video. So we still have this initial push down that I'm still labeling as either an A wave or a one wave to the downside. And the real question is here, do we have a wave B or 2 pivot in place? We certainly had a nice reaction from this Fibonacci zone between the 50% and the 61.8% retrace. And then, we sold off nicely, although we weren't able to break the new lows, and then start a bounce there on Friday from that higher low previous to this one here. So, I definitely think we're still set up here for another leg down. The question is, is this high going to hold before that happens? And how low do we go if it happens? And I guess there's still the potential for a bullish resolution here, although it's pretty hard to make the case here for it just looking at the waves. I mean, I really don't see an impulse wave, forming here off the bottom. So this looks a lot more corrective, choppy, sideways, which, would lead to another leg down like that, right? There's another scenario I'm kind of thinking about here just because it is so choppy. And that would be obviously a contracting triangle. And that would be, if it's a triangle in isolation, then that would definitely make this an A triangle B. And it wouldn't be a possible wave 1, 2, 3 down because a triangle cannot form on its own in wave 2. So let's just kind of go through that exercise here. So if we are forming a triangle, we have this very unusual A wave here. And then we have our B wave low in place. And then we're coming up for C. Could probably go a little higher here before we put C in. Of course, for this to count, we'd have to make a lower high below 29.43. Then you come down in D. Little pop up in E, and that will complete your B wave. And then you'd finally get that push down in C, and then possibly set up for a nice long opportunity to ride the next impulse wave up. Now, this is just a proposition at this point. I'm not seeing enough here to think a triangle is forming, although this choppy sideways action certainly has me on watch for a triangle to form. So we'll delete that for now, but I'll just leave this BR2 kind of up here as a placeholder since I'm not confident that there's a hard pivot in place. But if you do want to try and short this from near current levels, obviously your stop has to be right here, 29.43 here on SPX. All right, so that being said, heading into this week, what to look for? Well, I'm kind of thinking, since it isn't very clear, the only thing that's clear to me is this looks very choppy and corrective from the low. So I'm not feeling too bullish here by the looks of it, but it's confusing until we get a break. It's really, be aggressive here as far as the position goes. So I'm kind of thinking a straddle is warranted. And also this week, if we do get another leg down, and that's if, it's not a certainty that we do, but I think we're still looking pretty good for a possible leg down. If we do get another leg down, we'll see if it actually holds the June lows there. And let's see, that's at 2728.8. So if we get another leg down, but we're able to hold the June lows, then I'll feel pretty good about buying that for kind of a more intermediate term long entry. But if we do break those June lows, that'll kind of tilt the chart into a more bearish phase there. But we'll evaluate that if and when we get there. For now, as far as what I might do with it this week, and I suppose what I should do is go through last week a little bit. So last week I was kind of anticipating a potential short entry, but I didn't actually make one, and I was certainly tempted to at moments, but I'll kind of go through what kept me out of doing that. And okay, let me just get this cleaned up a little bit here. So I think we were kind of around here at the beginning of last week, somewhere in this area. And And I was saying, well, if we get some overlap with this level here, which I think I pointed out as, oh, there was an area between, let's see, 2873 and 2884. So I figured, well, if we get some overlap with those areas, and we actually overlapped, let me see, both of them, 2873.1, 20, yeah, so we got overlap for both those levels. So that took out the 1, 2, 3, 4, 5 interpretation because we had the 4-1 overlap. So okay, good. We got overlap. So now this kind of looks like a nice three-wave move up. We're possibly breaking down. So I was starting to get interested there. So I said, well, let's wait for a little retracement up, see how that looks, and then maybe get a short entry against that high there. Well, the very next day, and I think overnight partially, just had this huge spike up, took out the previous highs there, not by much, but took them out. And then that kind of clouded the interpretation. Then I didn't feel good about putting an entry in, so I didn't. And then looked like we were maybe doing some sort of little consolidation before maybe another pop up. And then boom, we came down the very next day, gap down, good follow through, challenged the lows, but then we started bouncing up again. So this kind of choppy, non-committal action just kept me out. There was a couple points there where I almost entered, and then it was just coming up too much and took out that pivot, so that kept me out. But had I entered short there, actually it would have been a pretty nice little swing trade down, but I didn't. So now I'm kind of watching this. If I see this come up here, make a lower high below this pivot, I may consider selling some futures with that as a stop. So it would be a reasonably tight stop. Let's say we get to 29, I don't know, 29.15 or something, and the stop is at 29.43. That's not too bad if you're looking for, 100 plus points down or whatever the target would be from there. But that's kind of what I'm thinking heading into this week. Potentially a short entry with a decently tight stop if we get a pop here and fail to make new highs, or another possibility here, and we'll go to the thinkorswim charts now at this point. And let me bring up SPY, because that's probably what I'd be looking to use to do this. And let me just clean this up here. Okay. Daily chart should be okay. So SPY. And let's go to the option chain. So since it's kind of non-committal and it's not clear which way it's going to go, at least near term, even though there's a bit of a bearish bias currently that I think is warranted. So let's go look at some September options. Enough time for this to play out, but not too much time that they're overly expensive. And I'm thinking maybe a straddle here, an option straddle. So right now at the money is, let's call it 289, although that could easily change tomorrow in the regular session. So this is just for informational purposes. The strike price would likely be different tomorrow if this is the position to be put on. But let's go with the at the money, or basically at the money straddle, 289. So right now, let's see, straddle. That would cost you around $12.50 or so on SPY. So you'd need roughly 125 point move before expiration to break even on SPX there. So let's just kind of look at that. Do a quick analyze of the risk profile for that bad boy, and there you go. Okay, so your upside break even at expiration there, and remember that's at expiration. Obviously it gains value in either direction a lot sooner than that leading up to expiration, but let's just give it kind of that worst case scenario if you held it all the way to expiration. So our expiration break even points, let's call it 301.50 and 276. So 301.50, and we'll get up some levels here. 301.50. Okay. And let's just extend this. Yeah. Okay. And what's the other one? Let's see. That was let's call it 276. Okay, throw that on there for that level. 276. Okay. And where are we now? Okay. And let me just change these colors here so they stand out. And what should I make it? Black? How's that? Make them wider. Okay. That's clear enough. Okay, so roughly an at the money SPY straddle going out about a month. These are your break evens at expiration to the downside and then to the upside. So I think that's a pretty reasonable proposition that we either, have our low in here and we're just going to go up and make new all-time highs again for no good reason, which certainly happens. It's happened before enough times, so it shouldn't be that surprising. And in that case, we'd probably get a nice move up well above the break-even point for the straddle to the upside, and the break-even point for the straddle to the downside is basically if we get down to the June lows or break them, we'd certainly be looking pretty good there on the straddle as well. So basically, if you believe in the next month or so that we'll break out of this range we've been in, this straddle wouldn't be such a bad position. And also, this is if you did no follow-up action. So realistically, if you if you did start breaking down and more bearish confirmation was put in place, you'd probably get rid of the calls before they were worthless, and then your profits would be coming in a lot faster, and your break even would be a lot higher up here on a downside move. And conversely with the calls, so if we get a bullish resolution here, say we get above the highs here, regain the 50-day moving average, start trending up strongly, well, you get rid of the puts before they're worthless, and then obviously your upside break even at expiration would be come down substantially, and you'd be making more profit more quickly. But that'd be the follow-up action for the straddle. So basically, you do the straddle, let the market pick its direction. Once it confirms, starts trending, close the leg of the straddle that's going to be losing, and then ride the rest up or the rest down. So that's not a terrible proposition here. So I might look at that tomorrow, at least starting a position like that. Doesn't have to be huge, but at least put on a starter position. So there's that. But okay, that's basically trade talk. So let's just get back to the analysis. So looking at just the SPX daily candlestick chart. So obviously a big change in trend here, at least medium term. We've been using that T-line area kind of as resistance, and actually we came up. So you see we broke the 50-day moving average, bounced up, kind of congested around it, found resistance at the 50-day where it was formerly a supportive moving average, and then falling down from there again. Didn't get to the 200 yet, but it looks like we're close enough that the market may find it irresistible not to go touch it, but we'll see. And we just bounce up on, Thursday we had a bullish hammer from a slightly higher low. And then we had a gap up on Friday, but you can see we basically closed just at or below the T-line here. And let me see, T-line as of Friday was at 28.88, and we closed at 28.88. So yeah, we basically closed right at the T-line. So if Friday's high remains intact, and we fail around this level, that's a pretty good bearish signal that, okay, now we're using this T-line as resistance instead of support, as it would have been in this, in an uptrend. So that's a nice signature, but we'll see how we open there tomorrow. Now, let's see. So that's the daily. I'm not seeing any strong signals other than that bullish hammer and a gap up. So keep an eye on that. If we do regain the T-line and we can start closing above it, that's certainly constructive for more upside, but we'll see. Now, as far as the weekly candles go here on SPX, what do we got going on? So we had this big weekly, not quite a bearish engulfing, but certainly had the spirit of one. Obviously, we had this range of the previous 5 weeks, this range, and then basically one candle covered the range of multiple weeks. So that was a bearish reversal down, closed below the weekly T-line. We had a weekly bullish hammer, but then the next week, so this most recent week, we had another hammer, but really no follow through, and we're still closing below this weekly T line. We got a bearish cross of the 3 T line below the T line, and we're just coming off overbought conditions on the weekly oscillator, and nowhere near oversold, and we're nowhere even near the the previous support area on the oscillator that we found on this pullback. So it looks here like the door is certainly still open to further downside. Also, that 50-week simple moving average, you see we came and interacted with that on that last pullback, so it wouldn't be unreasonable to come and do that again, even if we are just doing a fairly ordinary pullback that will lead to another move up. So yeah, kind of looking bearish here on these technicals, favoring some more downside, but we'll have to see how Monday looks here. And okay, that's SPX. And the Dow Jones Industrial Average. So the Dow, similar movement to the other indices, but just a little bit of relative weakness is what I'm seeing. And let's go through what I mean by that. So on the Dow we already actually went through that 200-day moving average, so we haven't gotten there yet on SPX or the NASDAQ composite. So we broke the 200, basically danced on it, had a little move up off of it. So we had a bullish hammer there on Thursday on the Dow as well, gap up. But we're not even at the T line here. Didn't even touch the T line on the Dow. So we're having more trouble touching the T line on the Dow. We already broke the 200 on the Dow. So that's just a little bit more relative weakness. And we also only did a 50% retracement of the initial move down on this pop-up we had. So just a weaker retracement all around here on the Dow. A little bit more relative weakness on this recent bounce we've had. But overall, similar implications. Looks like we still need some downside here to complete the larger pattern, but watching this carefully. Let's look at the weekly here on the Dow, if there's anything standing out there. Okay. Basically a similar look here. The candles look very much similar. And you see we already, poked through the 50-week simple moving average here twice now, which we are also unable to do so far on SPX. So just the Dow, just basically the same implication, but just a little bit more weak relative. Okay, not much more to say about that. And I don't typically do any trades related to the Dow, but it's still certainly good to keep an eye on as far as being a major index. Oh, another thing. So on the Dow, we actually did make a new low. Okay, that was on Thursday. And that was a lower low, whereas on SPX and the NASDAQ, we did not make a new low yet. So that's another sign of more relative weakness on the Dow. So just to point that out. Okay, now on the NASDAQ composite, let's have a look here. NASDAQ composite, this looks very similar to SPX. And you can see we kind of failed here after testing that 50-day moving average as resistance. And came down, couldn't make a new low. 200 is still within reach here on another poke down. And we came up and basically closed at the T line here on the daily on Friday. So you know what I kind of like is on all the indices. So we had that gap up from Thursday, touched the T line here on Friday, basically closed at it. If we come down and close this gap, I mean, that seems like a nice probable move. You see all these gaps tend to get closed, although the gap down we had up here has not been closed yet. So that's somewhat of a bearish sign. If you come up and you can't close that gap is now resistance, and now we're coming down. So we'll see. But what I kind of like is we have a gap up that needs to be closed to the downside, so that makes me think we need to come down and do that. And if we come down and do that, certainly new lows are within reach. But again, we'll see what it looks like come Monday morning here, and certainly I wouldn't read too much into the open. Sometimes you get these big pops on the open, and then it just fades all day and turns into a bearish candle. So let Monday kind of sort itself out, see how we're looking towards the close, maybe before making any big decisions here. I do like that straddle idea, just kind of let the market pick its own direction, and then once it confirms, make adjustments to that straddle, close the side that's going to lose, or something like that. Yeah, okay, so we'll go, that's composite. The weekly, let's have a quick look at the weekly here on the composite. And This is a clear doji star on the NASDAQ weekly, and also rejecting that weekly T line. Did touch it inter-week, but obviously rejected it on a closing basis. So a doji star could be a reversal candle, but it could also just be a pause in an overall trend. So in this case, it could be a pause within a at least intermediate term downtrend. So we'll see. Not much information though, just basically an indecisive week according to that candle there. Okay. Well, that's composite. We'll go with the VIX. And the VIX, I think I pointed this out before, but the VIX is in an uptrend now, so that's a little bit of a bearish sign. Tilts the odds a little bit more in that direction. So we had this low on the VIX, 1103, and that was back on, April 17th. Yeah, so then we had this spike high on the VIX, and then we came down as the market was going up. Made a higher low on the VIX, despite the market making a higher high. So that was a little bit of a divergence between VIX and SPX. Even though the market was making new all-time highs, VIX was not making new relative lows. And then obviously we had this VIX explosion from there. So now we have a high, a higher low, and now a higher high in VIX. And now it looks like we're consolidating in VIX. We're still holding on to some elevated levels, relatively speaking. And looking for another move up in VIX. Now, the question is, when we get a move up in VIX, if and when, do we get above this previous high or do we make a lower high? So if we get up here on VIX, the market, let's say the market stabs down, hits the 200-day, makes a marginal new low or even a substantial new low, but VIX is unable to make a new high, that would give us kind of a bullish divergence. So even though market's selling off, making new lows relatively to VIX, VIX is making lower highs, so that's kind of telling you weakening of that downward momentum, and then looking for possibly a long opportunity on the indices, and maybe a shorting opportunity on VIX, although not my favorite thing to do, short the VIX. That could go badly if you get it wrong. So that's what I'm kind of seeing on VIX. It's just elevating the bearish scenario just a little bit here, going off of that. And let's see, on that VIX tool, so what am I seeing here so far? So we did get another sell signal right here. And let me just show you where that kind of broke down. So here we had the VVIX get above its red moving average. We had SPX get below its blue moving average, and we got some decent follow through. So we basically went on confirmation of that signal. We went from roughly 2,900 on SPX to as low as 29.25. So we got a decent 75-point move down. So that wasn't a bad signal to take. But then we started bouncing again, and now we're basically neutral, possibly setting up a buy signal, although it's not quite there yet. But you'll see there is already some potential divergence. So here VVIX made a higher high relative to its previous high there. VIX did not. VIX made a lower high. Okay, so that's the VIX divergence. So that's in place. And now we're looking to see if VVIX gets below the blue moving average. SPX, it's basically above the blue moving average or slightly on it. But if SPX really starts moving above this blue moving average, we basically have a buy signal using this tool here. So I'm watching that carefully too. Although in these kind of sideways, choppy, range-bound scenarios, this thing can produce a lot of false signals because it's not trending, right? You just get a signal and then it reverses, and then you get another signal and it reverses. So I have to kind of put that in the context of what the market's been doing here, and not pay as much attention to these signals. Although I'm certainly still aware. Okay, we got a potential buying signal setting up, so I won't ignore it. It would probably keep me from shorting the thing, but it wouldn't necessarily make me want to go long. Again, I kind of like the straddle idea. Let the market pick here, because this has been very tricky action. Just when you think it's going up, it goes down. Just when you think it's going down, it starts coming back up. So soon that will stop. You will get a break of significance in one of the directions. So that's kind of the premise for looking at that straddle tomorrow. But we'll see. Okay, so that's probably good for now. Yeah, definitely heading into tomorrow. If you do want to try and just outright short this, if we get a little pop up tomorrow and it starts fading from the open, that's a decent place to go short. Obviously, your stop would be this high here, 29.43 on SPX. And let me just put the same level. So if you're actually shorting the futures here, like I would likely be looking to do, your stop on the futures would be 29.44.25. So just above that, 29.44.5. That'd be your stop if you sell short. And currently, I mean, you're not risking too much there. Maybe, I don't know, 40 points or something between your stop, and then you'd be looking for probably an over 100-point drop. So not a terrible risk-reward ratio, but that's what I'd be looking at tomorrow. Either sell a nice spike up, put in a decently tight stop, or just buy the straddle and let this thing kind of decide for you. But we'll check in if we get something major this week. But if we just stay in this range, which I doubt we'll stay in the range for the whole week, but if we do, I'll certainly do another update next weekend. But I'll do it sooner if we get some action. All right, Serial Trader signing off.